Hello everyone, my name is Jeff Boccaccio from the Systems Lab, and today we're going to explore all things position sizing. Now, before we get going, consider yourselves disclaimed. You guys know the drill. I'll let you pause and read at your leisure. Today we're asking the question, was Van right about position sizing? Now, Van, if you guys don't know, was one of the original market wizards. He was known mainly for his work on psychology, but he did tons of work in position sizing, including writing the definitive guidebook highlighted here. So one of the things that he used to say, or just to summarize, this is a great little quote, is he said, position sizing, not the trading system, is key to achieving your objectives. So what that means is that, the system doesn't matter as much. Position sizing is what's going to get you to where you want to be. So we're asking if he was right on this. And we're going to compare the results of 4 different position sizing methods to see. Now, in order to do that, we need a baseline trading system. And we may be a little bit biased here at the Systems Lab, but we're going to use the PRX system, the swing version of PRX. And this is one that we've made here in-house and that we teach. And actually, we taught this the first time at the Van Tharp Institute. So it seems like an appropriate sort of system to use for these purposes. Now, here's the system setup. Specifics are here, along with some sample trades. It's a long-only system, so the green circles are buy, the red is sell. The blue bars are where the winning trades, the orange ones are some losses. You can see the winners are bigger than the losers, right? Now, for all of the different models we're going to check here or test here, we've got backtest data that goes back about 10.5 years on GBTC. That's one of the spot Bitcoin ETFs. And we're using a starting capital at 100 grand with no leverage for any of these, right? So we're just using a fixed amount of money to start with. So let's get right into the first model. So model number 1, and by the way, we're using our PRX strategy for TradingView that we offer for doing all of this work. And for those of you who are subscribers, I put the settings in here in the bottom right so that you can kind of follow along and check it out for yourselves and make sure you get the same results. So anyway, model number 1, this is fixed amount of currency. This is how we've always run PRX. And it's basically just saying we're going to risk $1,000 per trade. And so that, if you're using the Van Tharp parlance, there's a concept of R. R is risk, and risk, or R in this case, is $1,000. So if we take a trade and it loses the full amount, we shouldn't lose more than $1,000. So a couple things to point out on this one here. And by the way, all of the other models, we're going to use the same looking sort of metrics and equity curve here. So you can see the equity curve looks pretty good, pretty healthy up and to the right. We've got about a 61% return for a 4% drawdown, so not too shabby. The number of trades at 55 and the profitable trade, so the win rate at 42%-ish, will be the same for all of the models, okay? Because we're not changing the system, we're changing the sizing. So that is probably all that I wanted to highlight there. So $1,000 risk is the first one, fixed amount of currency. For the next model, percent account equity, this is pretty similar to the first, except we're tying the amount risked to the account balance. So, and that's a proportion of the account. So in this case, we're using a 1% risk per trade. So to compare to what we did before, the very first trade will be the same as before. It'll be $1,000 because it's 1% of 100,000, right? But after that, the system will flex depending on how well it's doing. And one thing that's nice about this model is when the performance is doing well, the system is risking more. And when the performance drops, so does the size of the risk in dollar terms. One thing to note here that the equity curve looks quite similar to what we had before, but we had a boost in total P&L to about 78%. The drawdown in percentage terms is about the same at 4.4, but the dollar amount of the drawdown is a bit higher because the risk at that point must have been higher as well. So that's model number 2. Model number 3 is constant notional value. So this is working a little bit differently. It's basically how much capital do we want to allocate to each trade? Um, so now it may sound high. We've got this set for the 100,000, which is the same as the actual account balance. That does not mean that if we lose the trade, we lose the whole 100,000. It just means that we're allocating 100,000 to the trade, and then we're going to get out in the usual way. So the way that this works is that we position size it by dividing that 100,000 by the price of GBTC at the time of entry. And then, as I said, exit in the usual way. So what you can see here is that the equity curve again looks pretty similar, but the P&L is increased by about a factor of 10, right? We went from about 72,000 to 700,000. The drawdown increased quite a bit as well, but not to the same proportion. So a 10x improvement in P&L, but about a 7x increase in drawdown. And of course, the drawdown amount is going to be higher because the overall P&L got so much higher as well. So in this case, bear in mind that the R value, the risk per trade, is fluctuating. So it's different sort of each time. But when we look at the full stats, the average loss is about 6.7 thousand versus a average win of about 40,000. So it's much higher, the winners than the losers. Now, our last model is pretty similar to the last one. That this one is the percent account notional value. So rather than the fixed $100,000 capital allocation per trade, this one is using that proportion of the account as the account fluctuates, right? So we start with 100,000 just like before, but then as the account balance grows, we're risking whatever the account balance is, but we're not risking again the entire account balance on every trade. We're just allocating the entire account balance to the trade. Now, what you'll probably figure out here is that the performance is gone up by another factor of 10. So remember, this is the same 100,000 starting point, but we went to 7.4 million here. But the drawdown has gone up again a little bit percentage-wise, but not much compared to the overall P&L increase. The dollar amount of the drawdown has, of course, increased because the numbers have just got so much bigger. So this may seem a little bit extreme. And one more thing I want to point out here is that the equity curve has changed quite a bit compared to the others. And the large win that we had early on here is hardly making a dent really in this particular model. So let's go ahead and summarize all of these. And this just puts all those numbers into one nice table for us. One other little thing I did was just add in this ratio of the P&L in percent, so 62%, divided by the max drawdown of 4.2. And you can see that that sort of increases along the way and then makes a really big jump for that last model we were looking at. So I'm aware that some of these are pretty extreme and that it might not be how you would want to run a system, but it shows us how position sizing matters. If you were going to do this for yourself, this is really just kind of scratching the surface of position sizing. Really, you want to figure out what your constraints are, which is usually based on the drawdowns you're willing to accept, and then determine your size based on that. In our PRX courses that we teach, we show the research we've done on all the system variants with using Monte Carlo simulations of drawdowns and how we've looked at some of the sizing options here ourselves. So let's get back to the original question. Was Van right? Does position sizing matter as much as he was saying? And I think based on these results, we can say it's a resounding yes. Nothing changed in the system except for the sizing here. Now, if you'd like to find out more about PRX, check out our website at thesystemslabinc.com. We also have all the TradingView tools there, the same ones we've used to collect all of this data that we shared here today. And for all of you who are currently subscribers, all of these new position sizing models have now included as part of our recent update. And so you can back test. And if you're an automation subscriber, that means you can also use those models to forward run all of these strategies based on what you found works for you. So I'm Jeff Boccaccio from the Systems Lab again, and I hope this has given you at least one little insight and piqued your interest into diving a bit deeper into position sizing. Thanks, everyone. Cheers.